All right, ladies and gentlemen, this afternoon we have Michael Paulenoff, who is the founder of MPTrader.com and is a technical strategist. And MPTrader is a real-time diary of his index and sector analysis and trade alerts. He is a 32 Wall Street veteran, formerly with Smith Barney, Harris Upham, Drexel Burnham, Lambert, and Republic National Bank. Mr. Paulenoff is a popular speaker at financial forums and conferences and is widely published on sites such as The Street, MarketWatch, NASDAQ.com, and Business Insider. He also has co-authored of the Business One Irwin Guide to the Futures Markets with Stanley Kroll. Mike, we're so happy to have you this afternoon. The floor is yours.
Thanks a lot, Zach. That's a great introduction. I feel like I ought to be coming out with a cane and a top hat and music and the whole thing. Thanks again. Hi, everyone. I'm Mike Paulenoff, as Zach mentioned. And what you see on your screen now is the front page of my website, and that would be me, that picture down there. So you get a visualization of who the face behind the voice. In any event, I think we created this website in 2003, so we're almost in our 20th year, which is pretty amazing. But I've seen a lot of markets. I started my career in about 1979 after I got out of the Foreign Service School at Georgetown University in Washington, D.C. And so I've seen, well, you can't say you've seen it all these days because every day something seems to happen that at least makes my eyebrows roll up. But anyway, I've been through various cycles in all sorts of markets. And today, since our time is relatively limited, less than a half hour or so, I'm going to go over a few ETFs and markets that I think we all should be watching heading into the second half / final quarter of the year. So anyway, just as a thumbnail on the website, that's the front page. Then you click room, and we do all sorts of stuff all day long, but I start really early in the morning. And let's see, what's today, the 23rd. So where did I start this morning? So here's so people ask questions, and this was my first update this morning, and I guess it was at about Eastern time. It was about 6:54, about 7 o'clock Eastern time, and I do all sorts of interesting things that I see that I think our members would be interested in. This particular one update was about the comparison between the tech bubble in 2000 and 2022 and various elements or aspects of that. Then I usually start off the day with real-time analysis of the S&P futures, the E-minis, and I put up a chart, and you can expand the charts, and I have commentary. People ask questions, make comments. That is the other members, Apple, and so forth and so on. You can see Meta, October crude oil this morning. I put that up with my analysis, and the analysis is mostly technical with both market psychology and fundamental overlays. And that's a thumbnail sketch. There's a lot of updating going on. It's a lot of discussion. And a lot of chart work and a lot of trying to figure out what the heck is going on. And that's basically it. And it's a lot of fun, and it's interesting, and there are a lot of actionable ideas transmitted in our room. So that's the website. Okay, let's get now that we have the marketing out of the way, let's get to the subject matter for today. Come on. There we go. Okay. So we're in my charting package. Let me go over to the first thing I want to discuss today is, to me, what the last part of the year, the final part of the year, will be all about. And let me change pages here. And after I change pages, I'm going to go to a monthly chart of 10-year yield. And I want to start with this chart because I think it is the foundation for everything that happens, that will be happening for the rest of the year, for obvious reasons, not the least of which is Friday's Jay Powell speech. And this happened to me last time. The system is kind of slow when it tries to change pages. Hopefully it will do that soon. In any case, okay, there you go. Here we go. Okay, terrific. So if I can get this box, there we go. Okay, so now here's my monthly chart of 10-year yield. I'll expand it. It's not really worth expanding it because it goes back to about 1983 and there's no space to the left anyway. So, all right, so here's the chart, and what it is a massive downtrend in yield. Starts back at the high of 1984 and goes to that incredible low, well, 14% that is, in 1984. And it goes from upper left to lower right for 40 years, more or less, into the all-time low at 40 basis points, 0.4% in 10-year yield, which even the thought of even saying that out loud, it seems just outrageous. But anyway, that's what happened. It went from 14% to less than 1%. In fact, less than half of 1% in March of 2020. But this massive downtrend, you can see the upper trend line has been violated. That is to say, the March from the pandemic low in March of 2020 at 0.4%, the current up leg that extends into where we are now, August of 2022, took the 10-year yield up to 3.5% from less than 0.5%. And in so doing, not only took out a 20-year trend line, even more 25-year trend line, it also took out a decade worth of resistance across this light blue box. In classic fashion, after we peaked, or a 10-year yield peaked at 3.5%, it came down to the trend line to test it at around 250, to be exact, 253. And I'll show you the other chart in a minute, a couple of weeks ago, and has been rising since. Now, last is about 3.05%. And based on what I think is a bottom, I think, as you can tell, the dotted lines, I think the objectives are considerably higher in 10-year yield. And if that turns out to be the case, interest rates, and certainly on the long end, are going up. And regardless of what everyone is talking about, that inflation's peaked and all that other stuff, and that we might be going into recession, whatever it is about this chart that will take yield to above 350 to 420, possibly close to 5%. I don't know what we will be reading about. I don't know what we will be worrying about. But this chart is telling me that there's reason to do just that, to think that we're going to at least 420, if not much higher, mostly because, and this is what I have hard time getting my head around, is that you can end a 40-year bear market in yield, but I don't think you can end the flip side of that in 18 months. In other words, you don't correct or adjust a 40-year bear market in anything in 18 months. And that's what the yield bears want to believe. That is what the inflation peak crowd wants to believe that the Fed is done, that it can't afford and will have and will completely resist backing rates up beyond a certain level, where what that neutral rate is, I don't know, it's 4%, 3.75%. I don't know what the neutral rate is. I'm not sure anybody else does either. But this chart is telling me that in the next, I don't know, 5 years, we're going to climb the right side of this chart. And we'll probably end up in here somewhere, which is about 5%, maybe a little higher. And the underlying fundamentals, the reasons why we would go to 5%, well, we'll take a look at some things, and after we're done, tell me if you don't think that it's at least worth thinking about the path that I think we might be on. Okay, so as far as an ETF goes, the ETFs go, how do you participate? Well, so here's the TLT, and this is a chart that goes back to March of 2022, and the TLT is the 20 plus year US Treasury bond, and I like it as a proxy for the 10-year yield. And I realize there's a differential of time frame, and you could use one of the other ETFs that more accurately overlays with the benchmark 10-year. But I'm comfortable and very familiar with the TLT. So for my purposes, I use it as the vehicle to participate in a market based on what I think the 10-year yield will do or is doing. Okay, so here you have the TLT, and as rates go up, prices go down, and that explains why the TLT in price, this is a price chart, goes down, and it's been going down for quite a while. So if I click on the daily chart, and by the way, this is TradeStation software, and I've used it for years and years, and it does everything I need it to do, and I like it a lot, especially in terms of its versatility for the website and posting it to MPTrader. Anyway, so here's a longer term chart. This is a daily chart. It goes back to October of 2018, and the TLT is in a massive downtrend. So I would say, let's see, March of 2022. So this, from about here over, is this chart right here. And this is a 4-hour candle chart. So every candle is 4 hours worth of data. And, for the purposes of continuity, I put in some headline news, like when the Fed hikes rates. You can see them in the red outline boxes. And in yellow, I put in economic data, significant economic data, just to see what the data and the Fed dates are in relation to what price does, because to me there's context there. And so right now this is live. So TLT is 112 and change, 112.07, having hit 111.74. And the irony of this is the CPI comes in at 8.8% on August 10th. And yeah, it's a little cooler than expected. Maybe, it's cooler than 10% annualized, but it's still high. And instead of a cooler CPI encouraging buyers, it failed and rates went back up. Now, so much for cooler CPI. And as you recall, the S&P went up after that CPI and before this latest pullback. And so the two markets diverged. And one market, the stock indexes were reacting to, maybe the Fed, maybe Powell won't be so hawkish anymore because we have quote unquote peak inflation. Meanwhile, the bond market, and in my 40-year career, I've been told that the bond people are the smartest people in the room. Who knows? But those people were seeing something different. And they sold the news instead of bought the news. So right now, in the last, I would say, week and a half or so, both markets seem to be on the same page, and that would be this page. Okay, so here's the S&P based on the spider, another ETF. So from last week, a week ago, the S&P is going down, and then you go over to the TLT, and for the last 3 weeks, it's been going down. So the two markets are on the same page. And what are they thinking? Well, maybe they're thinking what the longer term monthly 10-year yield chart is telling us is that, well, maybe this is a bull move and it's the first leg up in a bull move. So to take advantage of it, we use the TLTs in a directional setup for a trade or a position. Okay, so that's the TLTs. What else would I use? What else would I look at to underlie a upward pressure in yield? Well, it's kind of like, well, eeny, meeny, miny, mo. Guess what you end up with is energy, of course. Okay, and before I use the XOP, oil and gas exploration ETF, let me see if I can get this chart to move and put up my oil chart. Come on. I notice when I get into one of these Zoom situations, the reaction time of the TradeStation software slows, which is not great for a presentation that's 30 minutes, but we do what we can do. So anyway, when it comes up, I'll show you the crude oil chart. Here it is. Okay. Okay, I'll use my 4-hour chart, and you can get a sense. I put this up just about every day. And so here's October crude futures. And I use a much longer term chart for context if I want to go beyond the dominant near-term trend. So the dominant near-term trend in crude oil is down from the June high in the October contract at 118, and it hit its low a week ago at $85. But since then, all this action seems to be rounding out. And today, sure enough, we popped above the trend line and closed above the trend line. So that's a significant move and a significant technical event in oil that is impacting the oil stocks, the oil sector, and the oil ETF. And so here is my last sort of update on a headline, which was yesterday when the Saudis made a comment out of the blue, or so to speak, it seemed like it, that one of their ministers and the energy ministers said that he thought there was a disconnect between futures prices, which he thought were too low, and the underlying fundamentals of oil. And therefore, the Saudis might have to actually cut output. Yes, cut output. Well, that was news to everybody, since everybody was thinking that they were going to increase output because demand doesn't seem to be slowing so much. Okay, so let's put that on the back burner for a minute. And so oil is now could be breaking out into another up leg. And if that's the case, what do we see in the ETFs? Well, I use the XOP for exploration, the exploration names. So you can see the names Oxy, XOM, CVX. They're basically all in this ETF, and the pattern in this is extremely bullish, on top of the fact that it already had an extremely bullish, enormous up move. So it looks like yeah, this pullback in oil when it went from 120 down to 85. So did the underlying ETFs of the oil companies, but now they've taken off again. And so I think XOP has a target, possibly 190, 200, which would take out this 170 high. And so if that's the case, we're at 146, 170, 146. So that's a 16% move just to get back to the prior high. And for 190, that's a 30% move to 190. So there's a lot of upside left. And of course, if it pulls back and it starts to take, or it jams into the 200-day and takes it out, all bets are off. And of course, we would use stops a lot closer than that, or manage the risk closer than letting it go back, $20 or $25 a share. But anyway, this pattern is unbelievably bullish. And when you look at this pattern, you say to yourself, well, this could go on for years from this pattern. Keep in mind, this pattern starts in 2019. So you got 4 years worth, 3 or 4 years worth of action, and it's still bullish. So it sort of adds to the impact of what this chart might be saying. If oil is looking like it's looking, and XOP and the oil stocks are looking like they're looking, well, maybe then there'll be a reason for rates to go up to 4.25 or 5.25 or somewhere in this range. Okay, so that's the oil side of things. And of course, you could use USO. I happen to rather use companies and ETFs of companies than the commodity ETFs themselves. So let's move on from there. So what else in the eeny, meeny, miny, mo idea to justify or underpin yields going higher? Well, for me, it's commodities. Okay, now as opposed to oil, let's put that as a different category. So what about the agricultural commodities? Well, what you're looking at now in this chart is a weekly chart of the DBA agricultural ETF. And what's in there is mostly grains, and I guess some soft commodities like cocoa, coffee, OJ, cotton, that kind of thing. But in general, this goes back to 2013, so it's 10 years. And you had a massive bear market from 2014 to 2020. Into the pandemic, it bottomed, which should sound familiar. And in addition to that, it turned up and broke out in 2021. And this is a massive up leg. And this looks to me, and I remember this is a weekly chart. So what I had shown you on interest rates was a monthly interest rate chart. This is a weekly commodity chart of the agricultural sector. And we had just come off showing you a daily chart going back to 2018 in oil in the XOP. So all this stuff is relatively long term. These are not, weekly. I'm saying 2 to 3 week swing trades. These are setups that have some legs, some shelf life. So anyway, to me, DBA, it ended its first up leg in April, and of 2022 has pulled back to its original breakout point, which is around 19 to 20, and it looks like it's turning up again to me. And weekly RSI, weekly MACD, they look like they're turning up or flattening out and turning up as well. So to me, this is another way to participate. It's not the sexiest trade in the world because if we, if we're in at 20 and a half and we're looking for 26, 24 to 28, well, it's not the highest beta way to participate, but it is it is a position that is suggestive of higher interest rates, higher inflation, and a world that we haven't been in, a commodity world we haven't been in a very long time. And it's more analogous to the 1970s. And everybody's comparing Powell's challenges now with the 1970s with Volcker's challenge, but we're not there yet. And I don't know if Powell thinks we're going to get there, and probably not, because he's probably thinking that at 4% Fed funds, maybe we can get inflation down to 4%, 5%. I don't think he really thinks in his heart of hearts that we can get inflation back to his target of 2%. But anyway, these charts between oil and agriculture and the 10-year yield in no way suggests Powell will be successful in driving inflation down to 2% from 8 or 9% in any time soon. But stranger things have happened. It just so happens that these setups are telling me the opposite. And so we're getting late in time. So let me put up one more thing to show you. And this is really off the beaten path. But for me, it's just part of the same situation. So here's the German country fund, really, EWG. And it's an ETF of basically the German equity market. Why do I put that up there? Because it's in a massive downtrend, and really all you see, well, now TradeStation is going to update. So I can't change the page if I wanted to, but at least it didn't knock us off. So anyway, the reason I put that up there is because all you read about is Germany's energy problems, and for good reason, because the Russians are squeezing Europe. So Germany is paying. I saw a chart earlier this morning that converted German electricity prices into dollars per barrel of oil, and they said that the trajectory of German electricity looks like it's going to $1,000 a barrel for oil. Yes, $1,000 a barrel. And, right now Brent is under 100. So, or that is to say that German electricity costs are the equivalent of $1,000 a barrel and that's where they're going. So anyway, the reason why it's important to me is because this is the flip side of the other charts that we've looked at. This chart is telling me that Germany is being squeezed because of inflation. And therefore, this chart won't be able to turn around until some of those pressures are alleviated. And so I'm not looking to be short this market. I'm looking for signs of a turn, because once this market turns, it's going to be evidence to me that the other thesis about rates going higher and oil going higher and the agriculture going higher, maybe those markets have peaked. So anyway, so this just and unfortunately TradeStation's upgrading, uploading data now, so it'll stop in a second and put the charts back. So I guess that's my cue to stop the presentation. And Zach, if there are any questions I can handle real fast, I will do so.
All right, Mike, looks like we are at time right now, but we do thank you for your presentation.
There's a nick of time.
What did you say?
I said in the nick of time, TradeStation took me out.
Right in the nick of time, but we will see you on the next one, and we'll see our attendees more this week.
Okay, thank you very much. I appreciate it, Zach.
Thank you.
Sure, bye-bye.